Event with our guest here, Michael Green. My name's Jonah Fox. I'm the founder of the Fordham Investments Club and a current alumni advisor there. I'm also a liaison to the Gabelli Center for Global Security Analysis. Tonight's program is hosted in collaboration with the Gabelli Center for Global Security Analysis and the Undergraduate Value Investing Club. I'd also like to take a moment to recognize the new leadership of the Fordham Investments Club, who were recently appointed and have done a fantastic job putting this event together. And we're going to be continuing the club's mission of connecting students with the best minds in finance and investing. We're honored today to host Michael Green, one of the most important thinkers in the investment world. Michael is currently the
No superlative.
no superlative. Michael's the Chief Strategist at Simplify Asset Management, where he oversees all ETF strategies and manages several top-rated funds. Over the course of his career, he's founded multiple hedge funds and has managed strategies at macro strategies at Thiel Macro. His research is focused on market structure, passive investing, and macro dynamics, and it has profoundly shaped how investors think about modern markets. We are also delighted to host a surprise guest today, Michael Taylor. Mike was a virologist turned top investor at Citadel and Millennium. Today, he manages the Pink Fund, an actively managed healthcare ETF at Simplify Asset Management that donates its entire fee to the breast cancer charities. A cool tidbit, his fund's also outperformed for the last 4 years, so congrats to Mike. No, 4 years. Number one. It's the number one. Okay, and so please join me in giving a warm welcome to Michael Green.
Okay, well, so first I appreciate that introduction very much. I will tell you, anytime anyone uses superlatives to describe somebody, it means they are destined for a fall. So I appreciate being framed.
Nice knowing me.
It was nice knowing me. Okay, so the topic of my presentation is called The Greatest Story Ever Sold, with an emphasis on the idea that this is largely a marketing story. The passive impact on markets is incredibly profound. The labeling of passive is incorrect, and as we'll talk about as we go through this, there is no such thing as a passive investor. And so what's unfortunately happened is that we have marketed and sold ourselves into a systemic risk that exists for us on a societal framework now. It's really quite terrifying, and I'm not quite sure what to do with it other than to try to make people aware. Very first thing to understand is the scale of what has transpired in terms of the growth of passive investing. When I started in the industry in the early 1990s, passive as an asset class was about 2% of the market. Today, using estimates that I've derived independently, that academics like Valentin Haddad or Marco Salmon have derived, or Bloomberg's analysts, we estimate that passive is about 53% by market capitalization of the US equity markets. All right, so the entire story of my career has actually occurred with passive growing in the background. Most people didn't understand this. The typical way of calculating how much of the market was passive was simply adding up the mutual fund shares from Vanguard, BlackRock, et cetera. That's very much an iceberg phenomenon. What you see at the top is, give or take, 2/7 of the totality. Also included in passive would include things like CITs, which are unregistered mutual funds that represent the majority of 401k and many IRA type investments. Any type of employee-sponsored program is typically done through a CIT, futures themselves, total return swaps, et cetera. And actually on the institutional side of the business, it's even more penetrated than it is on the retail side. That's where it started. That's where Wells Fargo first introduced it. It has grown more rapidly in the institutional space. In 2022, a professor I'm associated with, Marco Salmon, wrote a paper called Double What You Think, which explored this idea. The reason he stumbled across it was I was the adjudicant on a paper he had written in 2021, in which he scaled the problem by that 15%. I said that's wrong and explained why. He actually developed a methodology for looking at what fraction of shares are trading hands when an index reconstitutes itself. They came to the conclusion that only 5 funds, 5 indices, represented about 38% of all the market exposure. Right, S&P 500, et cetera. What they excluded from that 38% number included things like the single largest index fund, the Vanguard Total Market Indices, which are tied to the CRSP indices. Right? And so those are difficult because they own theoretically every public stock, and so it doesn't really matter. You can't track the turnover in that same way. If you add that component to it, you get somewhere around 50+% of the market that is now managed in passive frameworks. John Bogle himself acknowledged that if everybody indexed, the only word you could use is chaos, catastrophe, the markets would fail. This is predicated on kind of the traditional Grossman-Stiglitz thought experiment, what if everybody's passive, right? John came to the conclusion, which he made up, by the way, and he would actually have admitted this, that it was around 85%. But what that failed to calculate or capture was the process of moving from a market that was 2% market share passive to a market that's 85% passive share market. In that process, around 2015, something really important happened. Active vehicles began to experience net outflows, passive continued. And so we're actually more than 100% of the flows that are coming into the market today on a marginal basis. In other words, the marginal price setter is now exclusively passive. JP Morgan echoed this a long time ago, and I've got some more research that will show this, but fundamental trading, the stuff that theoretically is the Grossman-Stiglitz thought process on fundamental information flows, now represents less than 10% of trading activity. And in fact, if we go back to 1995, about 80% of the trading was active management with a very small fraction tied to noise traders and an immaterial fraction tied to passive investing. Today, the single largest category is actually the process of facilitating the investment in passive investing, things like market making in ETFs or mutual funds, right? But equally important has been this shift in the speculative trading, the advent of no cost, no commission trading, the emergence of options with no commissions, et cetera, has actually expanded the world of speculative trading and retail participation. Today, what we classically think of as uninformed noise traders are roughly twice the size of the entire active management space by themselves. That's before we consider the impact of investors like passive funds that simply have a very simple algorithm. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. Right? When passive strategies become too large, right, they're not actually passive. They are systematic algorithms. Again, when you give me cash, I buy, right? When I stumbled across this in 2016, I began exploring opportunities to identify markets in which passive had penetrated to the point, or systematic strategies had penetrated to the point that they were exploitable. And I stumbled across the inverse VIX ETF, XIV. This was a very, very popular trade from 2016 until 2018 when it rose roughly 600%, as you can see. There were articles being written in the Wall Street Journal about former Target store managers who were launching funds because it was just so easy to make money trading this thing, et cetera. I stumbled across this in May of 2017, presented at the EQD Derivatives Conference in Las Vegas, which is the largest equity derivatives conference, and presented the idea that this product could go to zero on a single day. The founder of the product happened to be in the audience, and we had one of those big short moments in which a discussion, I think is the appropriate term, ensued. I asked him if he thought it would survive in 1980. He told me I didn't understand the product. It's fine, it's probably true. Asked him if he thought it would survive a 1987 style event. He thought it would. I thought it would go to zero on a 4% decline, single day decline in the S&P 500. It went to zero on February 5th, 2018 on a 3.9% decline in the S&P 500. The takeaway from that is I'm very conservative. My employer at the time, I was managing Peter Thiel's personal capital. We had basically a $250 million bet that ended up working out quite well. I will also give you, since you're mostly students, advice. If you're going to trade on Wall Street and you're going to, I think the technical term is fuck over an entire complex, make sure that your counterparties don't hold the risk, right? And so like part of my communication process to this was to explain to the people who are on the other side of my trade in terms of market making activities, get out of this risk. I know you want to hold it. I know you think I'm insane. Get out of this. On February 5th, I got a lot of phone calls saying thank you, and that's actually how it became publicly available.
Hey, Mike,
Yeah.
for us quantity hedge fund guys,
Yeah.
could you just spend 1 minute to articulate how you articulated that trade and how long it took until it worked?
So the critical insight on the trade was that there is actually, so most options are priced off of a log normal distribution. That's how they were pricing the options on XIV. It was really on a competing product called SVXY. Anytime you have an inverse product, it actually behaves very, very differently. Is the price of the underlying gets higher and higher and higher, right? Or I'm sorry, as the price of the inverse gets higher and higher, the actual underlying is getting lower and lower. And so a smaller and smaller volatility shock was required to take it to zero. Effectively, a doubling on any inverse product, if it's the underlying, is going to cause it to go to zero. The VIX got down into the single-digit range in 2017. That persisted by and large until 2018. That created conditions under which a relatively small shock would occur. We simply applied the probability of that shock occurring to the pricing of options. We discovered that there was a fantastic mismatch, right? So a bimodal distribution is very difficult to price in options. Is that?
How long did it take until after you put?
Oh, all right. So I put, yeah.
Pain did you have to live through?
So the nice part,
Yes, I want to.
well, this was actually, so this was the critical insight, right? When an options market exists, you guys have all seen the movie The Big Short, right? What did Michael Burry do? Figure out an option that he could actually execute the trade on. You don't want to take the inverse of it. There are a lot of people who shorted the XIV. They also went out of business. The opportunity set that emerged was there were leaps trading on the SVXY equivalent. That meant that I could put a limited amount of capital out, know my loss, have it defined, and be able to sit. I actually bought 2-year options. That was where I did the calculation. There was roughly a 95% probability over the course of 2 years. It happened in 7 months. And so I actually dramatically underperformed versus what I could have done. As I said, I'm conservative. Okay, so here's the most important thing in this presentation, and it's not even my insights. It's actually Lasse Peterson at AQR. What is passive investing? This is literally taken from Bill Sharp's The Arithmetic of Active Management. A passive investor is one who always holds every security from the market. And an active investor is one who is not passive. So the critical question is, how do the passive investors get into the market? And how do they get out? Now, Sharp, in footnote number 4 to that paper, said, well, of course we know this isn't actually true. We're just going to assume that they trade in the liminal hours in which the markets are not open. Right? That doesn't work. Right? So really it boils down to magic. What is actually happening is every single day, money is flowing into passive vehicles. And as a result, they are always trading. They are always buying, and they are always selling. They're not passive. They're systematic algorithms. And systematic algorithmic strategies can get crowded, and that is unfortunately exactly what's happened in the market. Okay, so if we accept that passive investing can impact the market, how should it impact the market? This is actually a slide that I first produced in 2017 as I was explaining this to Peter Thiel. The first 6 points on here have not changed since 2016. The last component, portfolio effects dominating cash flow and discounting effects, has been added since. I'll explain exactly why that was. But you should expect to see an increase in correlation between securities with some interesting limitations. I don't have the perfect slide for it, but I'll explain what's going on. An increase in valuation of securities regardless of fundamentals as the passive share grows. In part, this is because there is a demand for more stock. They hold less cash. But more importantly, there's a momentum feedback, right? As something goes up, traditionally an active manager would actually sell that because unless there's been an increase in the fundamentals, that lowers the future expected return in a discounted cash flow type analysis. Right? Passive investing doesn't work that way. It assumes that the price is correct. So when something goes up, the next flow in buys more of it. All right, and this is a really critical change. Reduced market elasticity raises the risk of extraordinary price movements. Elasticity is here defined in a somewhat of a perversion of the economics term, right? Changes in price relative to supply and demand. We have actually assumed historically that markets were highly elastic. In other words, large flows would be required to cause a meaningful change in price. We've discovered in the last few years that that's not true. And part of that change has been the growth of passive strategies. Ultimately, passive strategies are very much like insider holdings. They aren't going to transact on fundamentals. Right? Insiders don't do it because they don't want to go to jail. Michael Saylor has a slightly different view of that interpretation. But the vast majority of insiders are not going to trade. And this actually has some really perverse effects. We'll talk through these things. An increase in market concentration as that momentum bias leads to the largest companies becoming larger. This is actually where most of my very recent research is on. It's what I call the price weight spiral. It actually turns out that passive investing crosses a threshold and starts to create its own momentum. It's really quite extraordinary. Or you could listen to races. Shame, Mike. All right. Reduced ability for new companies to come public. This is actually a surprising component. I'll talk through it in some detail, but the really critical insight is that to get a company public, you actually have to find somebody who's willing to deviate from their benchmark. That requires active managers. If active managers are facing redemptions, that means there really is no possibility of getting people to take exceptional risks, right? And so it becomes increasingly hard for companies to become public. Unfortunately, this is very much playing out. And then the last one is portfolio effects dominate cash flow and discounting effects. It's a little confusing, but in the simplest terms, nobody does a DCF anymore. If I'm running a portfolio that has to be automatically rebalanced to 60-40 bonds and equities, what I actually care about is did bond prices go up or did equity prices go up? And I'll change my weights between those two. Now that looks like discounting, right? Bond prices go up, interest rates go up, bond prices go down, and I have to sell equities and buy bonds. Right? It looks like I did a DCF, but I'm just rebalancing my portfolio. Okay, period of record correlations. This is a chart you're not going to see anywhere else, largely because I made it up. But this is actually looking at the S&P all the way back to 1927. And it's tracking not exactly correlation. Correlation is a really devilishly tricky concept. Right? It requires to do the S&P, it requires a 500 by 500 covariance matrix with instantaneous weights, et cetera. You're not going to find that data going back over a long period of time. Or you can cheat and take advantage of a mathematical property called Kendall's tau or binomial correlation, which is the same phenomenon that you get when you watch the Rockettes at Rockefeller Center at Christmas. Right? They're not all exactly the same size. They don't all have the exact same length legs, but if they move their legs together, it looks extraordinarily correlated. Binomial correlation dispenses with all the weighting information, et cetera, and simply says, did two stocks move in the same direction on the same day? And what we're finding is that more and more stocks are moving in the same direction on any given day. There's a couple of really critical dates that I've put in here. The first is the Investment Company Act of 1940. I need to shift the arrows because they're slightly off center here, but this arrow actually should be right about there. That actually had a really critical role on Wall Street. That's the introduction of the modern mutual fund, but importantly, in the aftermath of the Great Depression, it did something really, really important. It stripped firms of the ability to use undisclosed leverage. Right? Has anyone here traded crypto? Okay, what happens in a liquidity event? Everybody has to sell. There's a waterfall liquidation event. Right? That is what used to happen to equities in the 1930s. We got rid of that with the 40 Act. Mutual funds, by and large, were unlevered until 1994. Again, slightly off center. You can see I've updated the data, but not the labels. In 1994, Vanguard began to experience a challenge for index funds. They began to experience tracking error because they'd grown to be about 1.5% of the market. Their trading activity was actually causing the stocks that they were trying to buy on an individual basis to move in price. That meant that their performance didn't match the benchmark exactly. Tracking error is a very bad thing for index funds. They went to Wall Street and they said, hey, what can we do about this? We're these hicks from Malvern, PA. You guys are all sophisticated. And the street kind of looked at them, they're like, wait, why are you guys actually buying every single stock? Why don't you just buy futures? And they said, oh, there's this thing called the 40 Act. All right, and the 40 Act prevents us from using futures, which require margin accounts. The advice from the street was, well, that's silly. You guys are not trying to speculate. You're not trying to do, bad stuff. It's not like the 1920s all over again. You should just go to the SEC, lobby the SEC, and get what's called a no action letter that allows you to use futures, and then we'd be happy to help trade this. They did that. The Pitt SEC in 1994 passed a series of rules that facilitated the inclusion of derivatives on Wall Street more broadly, the accounting for them, and specifically gave a no action letter to index funds that allowed them to use futures. Crazily enough, this is what caused the dot-com cycle. Right, now, that sounds totally insane until you recognize that the indices at the time were market cap weighted. Most people think they're still market cap weighted. They're not. They're float adjusted weights. Right? In the 1990s, there was a unique confluence of relatively high market cap, low float companies, heavily owned by insiders, firms like Microsoft and Cisco and Dell, right? So when the street actually went to try to replicate it through the futures, they were trying to buy twice as many shares as actually were available to trade. If you try to buy twice as much of something as actually exists to trade, what's going to happen to its relative price? It's going to go up. Right? We didn't used to have factor funds, we didn't have insider ownership funds, et cetera, but we constructed wonderful academic narratives. Any of the academics in the room can tell you about all the brilliant papers that were written in the mid-1990s about the importance of insider ownership because management was aligned with you, et cetera. It was all bunk. Right? Nobody cares about insider ownership anymore. Nobody cares about insider selling. Nobody cares about the information content of it, et cetera, because it didn't actually matter. What was really driving the outperformance was the fact that those stocks got more buying from the futures index replication. As we progress through that, people naturally start to figure this out, right? They construct stories, we're going to buy these things, et cetera. Or you can simply do a Venn diagram of the overlap between relatively high market cap companies with relatively high levels of insider ownership. What do we call those? IPOs. Right? So the late 1990s was the exact same phenomenon we saw in 2006 in The Big Short. The street began manufacturing what we needed, new technology IPOs. Right? Now, when that crashed in 2000, they quietly changed the index construction in 2003 from market cap weighted to float weighted. This was among the most disingenuous and candidly dishonest presentations I've ever seen. Because what they did was they said, oh, it didn't really have much impact. They simply showed the index as if it had been reweighted, therefore slightly lowering it. Would have underperformed slightly in the 1990s. It would have outperformed in the period since. But what that ignored was actually the factor itself, right? The impact of that excess buying component, right? That went away in 2003. It bought us capacity to increase the size of passive without having distortion at the same levels. And then on February 5th, 2018, which is the day that the XIV went to zero, something happened that had never happened before in the history of the S&P, including the crash of '87. Every single stock moved in the exact same direction. It then happened 3 times in the fourth quarter of 2018. It then happened 5 times in March of 2020. It's happened a couple times since, but by and large, we've been relatively restrained. There's not been as much activity. I haven't fully diagnosed exactly why that's happening, although I have some insights on it. But the key point is that we're seeing this sort of crazy behavior. Now, one of my favorite experiences in having shared this was actually sitting on a panel. This is the last time I sat on a panel with the chief strategist for BlackRock, I'm sorry, I don't want to cast aspersions on the wrong firm. And he highlighted, well, you know, you've obviously got to be wrong here because the correlation was roughly the same in the 1930s. There was no passive investing. Does anyone else know what was happening in 1931, 32 that would cause the correlation to be really high? Yeah, the Great Depression. I mean, just that, right? Not a big deal. Stocks were already down 85%. So, like, to compare these two when markets are at all-time highs just feels completely disingenuous to me. Okay, before you start talking about how markets change, you actually have to weirdly figure out how they used to work. And one of the things I was most surprised by as I began doing this work was that there wasn't actually a holistic theory of how managers reacted to valuations. And so I decided to do some fundamental research, probably the last good work I ever did, in which I went out and I surveyed managers and I asked them a question. Surveyed roughly 450 individuals. I asked them a question. You're a portfolio manager. You have 5% cash in your portfolio. So cash is not a meaningful constraint in either direction, right? You receive an inflow or an outflow. How do you react to that inflow or outflow given valuations? And totally unsurprisingly, the propensity to sell rises with valuation. Your propensity to buy falls with valuation. Totally unsurprising. Your marginal propensity to buy falls as valuations get higher. Your marginal propensity to sell falls as valuations get cheaper. What was really surprising is this. The intersection at almost exactly 50-50. Remember, this is just a survey of 450 random people, right? At almost 50-50 at exactly the market's historical valuation average. Notice I didn't ask anything about interest rates. I didn't ask anything about where we were in the economic cycle, right? This is just a baseline reaction. And if you feed these responses from these managers into an agentic model, so I built a 10,000 agent model that was fed with the various responses, scaled up slightly by about 20 for each factor, and then I randomly gave them cash and I took cash away to see what the impact was. And the result is a mean reverting market. In other words, this is why the Shiller PE worked. because the participants themselves discounted. Right? Valuations went higher, they were more willing to sell. Valuations went lower, they were less willing to sell, more willing to buy. Right? So this is why the Shiller PE worked. Now the problem is, if you introduce a systematic algorithm, whose algorithm is, did you give me cash, if so then buy? Did you ask for cash, if so then sell? Who can tell me what their marginal propensity to transact on flows is? Come on, it's not a math class. 100%. Right? And so as you shift the composition of the market towards passive investors, what you're actually doing is shifting this off of the mean reversion to a mean expansionary framework. And if you run that same simulation with growing share of passive investors, here's your mean reversion that you had before, this is your new pattern that emerges. Mean expansionary valuations. Unfortunately, this almost perfectly matches what we're experiencing. All right, so here's the theory on the left, here's the reality on the right. It most affects the cap-weighted components because the largest stocks actually receive an additional impulse. But a lot of the narratives in the market are, well, it's just a really narrow market, and there's these AI companies that are super rich, and everything else is relatively cheap. Yes, it is. It is indeed relatively cheap. Right? That's a very big gap. But notice something. It's risen in valuation. The median stock is up about 2.5x versus its starting point. So I actually think the most overvalued segments of the market are some of the lower quality components where companies have borrowed significantly against an inflated equity value. I think many of these are actually zeros. That's not the only way that it impacts it. It actually turns out that the construction of the portfolio plays a very material role. Your typical active manager historically would carry between 5 and 10% cash. You would do that in part because the cash creates optionality in your portfolio. Cash represents a tool. I think of optionality all the time, but cash represents an option to buy without having to sell. It represents an option to meet a redemption without having to sell. And those redemptions tend to come at the most inopportune times, and so it's actually super, super valuable to carry cash in your portfolio. When you switch to investors like passive vehicles that don't really carry any cash, it has a very surprising effect. So let's just run through a theoretical model here. I apologize for the small print. I'll talk through all the words. So imagine there's only $1,000 total assets that are available to be invested, and they're all given to active managers in the market. And by definition, they're going to own 950 of equities and 50 of cash. If I, as a participant in the system, decide I want to take $10 and move it from active to passive, because we're talking about the total market, there can't be any actual transactions, they have to pay me out of cash. This leaves the active investors with 950 of equity and 40 of cash. They are underweight cash. I have that $10 of cash, which is 100% of my assets. I then give it to a passive fund that has $10 of cash and no equities, and now we actually enter into transactions. The active managers want to sell to raise cash. The passive managers want to buy to get equity exposure, right? So active sells 950, passive buys $9.99 to get to their target 10 basis points of cash, and it's all good, right? Does anyone know what the problem with that is? That's not a transaction. Buyers and sellers have to meet. I can't sell 950 of equities and have somebody else buy $9.99. So we actually enter into an iterative process to establish the clearing price. And unfortunately, that clearing price is that 1% move from active to passive lowers the percent of the market that is in cash and raises valuations by more than 1%. That's just a 1% move. Now consider the compounding effect of this. This is the cash in the market, and the valuations turn exponential, right? We are roughly right here. Again, I got to update this. That doesn't seem like much, but again, that's about 2 to 2.5 times richer valuations in order to accommodate this reduced desire to hold cash. In the past couple of years, so I started presenting this in 2017, in the past couple of years, there's been an explosion of financial academic research that unfortunately validates almost everything that I've said. Those parts that don't validate it, we won't talk about. In 2021, Xavier Gabay and Ralph Koijin wrote an incredibly important paper called In Search of the Origins of Financial Fluctuations, the Inelastic Market Hypothesis. Under the EMH, it's presumed that markets are highly elastic, that they can effectively accommodate trading of almost any size with very immaterial impacts, basically the bid-ask spread, because every buyer has a seller, right? The actual specification of the EMH is $1 into the market creates about 1 penny of incremental market capitalization. Gabay and Koijin's research suggested that number was closer to $8. Right? My work actually suggests that if you bifurcate active managers and passive managers, it's about $2 of market value that is created when the money flows to an active manager, because among other things, they have the option of holding cash. They don't have to transact. That money flowing into passive actually changes the multiplier based on how large the share of passive is. Again, it's more and more like trading insider, heavily owned insider stocks. And it actually turns out that right now that estimate appears to be about $20 of market capitalization is created for every dollar that is contributed to a passive fund. And this, of course, was Gabay and Koijin found. The price elasticity of the aggregate stock market is small, and flows in and out of the stock market have large impacts on prices. So I like to point out to people that, like, we complain about the government sector all the time, but the entire investment community has misspecified the EMH by anywhere from 800 to 1 to 2,000 to 1. We're not very good at this either. Okay, how does a market transitioning from active to passive behave? Well, the world's largest active fund is the Fidelity Contra Fund. It's about $150 billion in assets, carries about $4.5 billion in cash. Pretty much in line with what I would have expected. That cash balance is lowered as funds find themselves competing more and more with passive firms that are fully invested. But look at the world's largest passive fund. This is actually just one share class of it, so the total size of the Vanguard Total Stock Market Index is about $1.8 trillion. As of April, they were carrying negative $900 million in cash. How is that possible? Well, in the sell-offs in April, they couldn't find a buyer for the other side, so they tapped lines of credit. You guys are not active market participants, so you don't see this stuff, but Vanguard was literally sending out emails to its investors in early April saying, don't sell, good time to buy, right? And I was just telling this to Paul Johnson, the single scariest comment that I heard coming out of COVID was not, you have COVID. It was a self-congratulatory letter that Vanguard released in April of 2020 saying less than 1% of our clients tried to sell. And my reaction to that is, holy shit, imagine if it had been 2. Volatility on fundamental events like earnings announcements is rising as passive holders do not react to these events. There's nobody from Vanguard on the Apple earnings call. And so effectively, we're right back into that late 1990s phase in which more and more trading amongst active managers is happening in a reduced liquidity environment. They're basically forced to trade amongst themselves, right? So an analyst at Millennium thinks Apple's going to beat, and an analyst at Balyasny thinks that Millennium's going to miss. The analyst at Balyasny is correct, but he gets fired because the market goes up. I'm joking on that part. But the simple reality is that they're trading on a reduced liquidity set. This is looking at the average earnings day move over the last relative to average volatility. Now, this is one of these really perverse components, right? So clearly, this is rising on a trend basis. I love this chart from Goldman Sachs because it has an average here. This is as of late 2024. This is the same chart, literally the same construction of the chart as I showed you on the correlation before, right? And what's actually happening here is this reduced liquidity component to it. But if you think about this from an academic standpoint, isn't more movement on fundamental information release a more efficient market? Right? So unfortunately, our definitions are actually telling us this is increased efficiency, even as any rational market participant could say, wait, this is insane, right? I mean, Facebook was down 20%, right? That didn't used to happen with the large cap stocks, in part because the information on any one earnings release really never changes by anywhere near enough to affect that type of volatility. But in an academic world, it's great. This is actually an incredibly, incredibly important chart. This is from Valentin Haddad, another academic who has a paper. I think Gabay and Koijin will ultimately win the Nobel Prize for their paper. Haddad's paper is really fantastic, though. He identifies that the large increase in passive investing in the last 20 years has led to substantially more inelastic aggregate demand curves for individual stocks. This is where all my recent stuff is on as well. When demand is more inelastic, small changes in market structure can have a large effect on prices because investors are unwilling to change their position. Right, now this chart is showing you market capitalization against elasticity. Right, and remember, elasticity measures how much does price have to change to accommodate changes in supply and demand. The smallest companies are going to be more elastic than the largest companies. We actually know this to be true in a fundamental or theoretical framework. That's actually what this red line is. This is a fixed elasticity per stock. And what we actually know is that liquidity does not scale with market capitalization. Apple is $4 trillion in market cap. Delta Airlines is roughly $30 billion in market cap. Give or take 1,000-fold difference or a 100-fold difference between the two. Apple only trades about 10 times more than Delta Airlines. Right, and there's a variety of reasons why that is. The biggest one is that market makers are ultimately capital constrained. They have to choose where they're going to deploy capital, right? And part of that calculus is that the profitability of market making operations is a function of how wide is the bid-ask spread. It tends to be very low on the largest stocks and the trading volume. And so they're going to allocate more capital to making markets in smaller stocks than they are to larger stocks on a market cap proportional basis. That's what that framework is. The actual empirical data is a much steeper curve. And my hypothesis for this is twofold, but the most important one is that this is largely reflecting two factors. One is lack of substitutability. If I'm running an index fund, do I have any choice about whether or not to buy Apple or NVIDIA? No. Do I need to buy Delta Airlines? No, you know what, it's 0.02% of the index. It's not going to have any meaningful impact on my performance whatsoever. So I can buy that at my leisure. And by the way, I can also substitute United Airlines for it if I'm statistically sampling, right? So I have no real factor exposure to it at all. So there's a lack of substitutability here. The other component, though, that is ultimately really, really important here is the largest stocks are being bought because of that outflow that's coming from active managers. So active managers tend to skew towards smaller stocks. It's not true that active management in total owns the same as passive, in part because there is no passive. But when you have redemptions coming from the active managers, they tend to be actually providing liquidity to the exit on the smallest stocks. And so I think this is a temporal shift. I don't think it's a permanent shift, but it's really critical in terms of understanding what's ultimately happening right now. So perversely, the largest stocks are the ones that are most affected, and therefore it has a giant impact on the market. Zhang at Michigan State has a paper called The Rise of the Mega Cap Firm that actually identifies this. I believe he improperly specifies it as tied to idiosyncratic volatility, but it ultimately says the same thing. Right? That in turn is driving concentration. The passive model allocates more money to the largest stocks. Because there's this liquidity mismatch, they see the largest increases in price, which makes them even larger in the index, et cetera. That is somewhat known at this point. What isn't known is that the SEC is still helping. So in September of 2019, many types of passive indices, in particular things like the S&P 500 growth, actually crossed a concentration threshold in which they became classified as non-diversified stocks. Right? A non-diversified fund can't be marketed in the same way as a diversified fund, which was terribly unfair to Vanguard. And so they again lobbied the SEC, and the SEC said, oh yeah, that's cool. Right? This is one of the really sad parts of this, is that regulators are on board for almost every part of this. I would argue largely because they don't understand, but they are facilitating everything we see. Okay, bonds. Wouldn't be enough as this was stocks. It actually turns out that the bond story is equally bad, if not worse in some ways. Who was buying all the negative yielding bonds? The argument that we heard on the street was that this was asset liability matching. It was largely European insurers who needed long duration assets that were buying things like the Austrian Century bond. That's absolute bunk, again. It turns out that the largest holders were firms like Vanguard, BlackRock, and Capital Group, the largest providers of target date funds, because by and large, they construct bond indices that are built on the basis of the market value of the bonds. Now, the great irony is even Vanguard will acknowledge that market cap weighting for bond indices is stupid. Equities, we can at least argue, right? We can say, hey, it's at a higher price because people have higher expectations for it, and therefore we should allocate more money to it because this is the market's collective wisdom. A bond that's trading at 150 to par, I know exactly where that's going. If it's a high quality bond, it's going back to par, right? So bonds don't have the same open-ended characteristics to them as equities. Their distribution of returns looks much more like an American football, right? Slightly in flight, right? We're going to get a positive return associated with it, but if it's very high price relative to its par, it's going to fall in value as it comes to maturity. The reverse is true at the lower end. When you market cap weight bond indices and the Federal Reserve cuts interest rates, this will probably be the only time I mention the Fed, the second to only time in this presentation I mention the Fed, because there's nothing really nefarious that's going on. But when the Fed cuts interest rates, what happens to the price of long duration, low coupon bonds? They rise. They become a higher weight in the index. I just mechanically imagine there's only two bonds in an index, a 2-year bond and a 30-year bond. Right, they're equal weight at the start. The Fed hikes interest rate. What happens to the 2-year bond price? It goes down a little, but not very much. What happens to the 30-year bond? It goes down a lot. I've now changed the weightings in the indices, so the next dollar in buys less duration. Right? This is actually what's been happening in the U.S. equity markets, where it appears, or U.S. bond markets, I'm sorry, where it appears we've lost control of the long end. Right? This is the narrative. Inflation is running wild. The simple reality is it's largely a byproduct of passive investing, which has now become the dominant flow in the bond markets as well. It has actually just crossed the threshold that equity markets crossed in 2016, where net flows into passively managed funds are now positive. There's some debate as to whether or not the active manager community is seeing negative outflows yet, but it is clearly passed as the marginal player. You can actually see this, by the way. This is the shape of the U.S. bond curve right now in terms of its exposure within the total bond market index, the Vanguard preferred vehicle. Because the Fed cut interest rates, short end is priced at a premium relative to the long end. As a result, the next dollar that comes in buys a lot of short end, not so much 10s, not so much 30s. You'll also notice a distinct difference here, new issues. They can participate in auctions. Those are issued at par. They come through at a normal weight. But a bond that's priced at 65 cents, like the 30-year zero coupon, is trading somewhere around 68 cents. Right? It receives less inflows. This has actually given rise to yet another hedge fund trade that is the same as the index arbitrage that we see in the S&P 500. It's what you may have read in the newspaper referred to as the basis trade. Right? The basis trade literally looks exactly like, in terms of its representation, literally looks exactly like the Fed funds chart. Fed raises interest rates, drives duration off, makes off the run very attractive relative to the new issue. There's an arbitrage that can be executed in the bond market because these are ultimately cash instruments. As long as you can obtain financing, you can actually pull this trade off. So this is actually, unfortunately, increasingly driving our bond market as well. The Treasury Secretary is aware of this. I believe this is why they've started aggressively repurchasing many of these off-the-run issues. Okay. We did the, reduced ability for new companies to become public. When I first started sharing this chart, SPACs were in full bloom. And so this chart actually, I'm sorry, when I first started talking about this, SPACs hadn't yet emerged. And you saw this pattern of reduced IPOs despite the fact that markets were hitting all-time highs. And then all of a sudden in 2020, this thing's called SPACs showed up. Right? Now, SPACs have actually been in the market since the 1970s. They're actually a little bit of a game that hedge funds play. Among other things, they're a really attractive asset. If I want to hold cash in my portfolio but not reveal to my investors I'm holding cash, I can put some money in a SPAC pre-acquisition. I get some volatility components to it, but I ultimately have a cash instrument. All right, so it shouldn't experience that much price volatility. I get some optionality around it. Sounds good, kind of a cool thing to play with. I'll pretend to let the guys make the operating acquisition. And then they went absolutely bananas around COVID. All right, and the reason why actually turns out that it was in the fine print of the total market index. It's run by this is what Vanguard uses. This is from August 2020. And I apologize, there's nothing I can do about this. SPACs are not eligible for index inclusion. Well, what the hell are you talking about, Mike? Turns out that SPACs are not eligible for index inclusion until they make an operating acquisition. And then they are evaluated based on the size of the acquisition. If the acquisition was of sufficient size to clear the 85th percentile threshold for the Vanguard Total Market Index, the CRSP Total Market Index, then it became eligible for what's called fast-track IPO status, in which the index providers had to buy their allotment in as few as 5 days. Does anyone know what the rules of SPACs are in terms of when insiders, who are the sole source of liquidity in SPACs, can sell? It's typically, well, that's a traditional IPO, which is one of the reasons they struggle, but with SPACs, it's typically 20 days above a threshold level. If the world's largest asset managers have to buy 5% of your company in 5 days, and there is no liquidity, what's going to happen to the price? It's going to go bananas, right? And so I actually fortunately saw this in advance, got a lot of my friends in private equity and venture capital to dump SPACs to you guys. I appreciate you buying it for us. But this is why you have things like Nikola, right? Remember the truck being rolled down the hill? The largest buyer was Vanguard. Right behind them was Norges Bank, which is actually the Norwegian pension plan that basically is another index fund. BlackRock brought up the rear. All the rest of these are insiders. I like to use movie references. You guys have seen Animal House? Okay. Niedermeyer, dead. Private equity, dead. Why? Because in September of 2023, they changed the rules. And they actually moved SPACs from the ability to be included in the index on fast-track IPO status. This cut off the pipeline. From this point, private equity payouts have collapsed. Despite the fact, by the way, that private equity tells you that their assets are up about 40% over that time period. Another movie reference, Cool Hand Luke. What we have here is a failure to communicate. I like to do this chart every single year so I can just keep updating it. Every year the forecast is for tons of IPOs. Every year it goes flat. Okay, this is where it gets really, really fun because I get to be a loser here. One of the core assumptions in finance is modern portfolio theory, which holds that asset returns can be modeled as somewhat normally distributed around an expected return, right? Expected return to stocks is 8.5, well maybe it's 9, probably 11 actually, over time with cyclical variations around that, right? Here's the problem. What I just showed you is that we now have a mean expansionary framework that's tied to time, the passive share, right? We have a leaky bucket for active managers where their clients are largely old. They're not getting hired anymore because they're no longer eligible for participation in 401ks. In 2006, we introduced the Pension Protection Act, which changed 401ks from an opt-in framework. You had to choose to participate and select what investments you were going to an opt-out framework. I don't know how many of you have had jobs or had a 401k recently, but typically now you get a 401k package, you are automatically defaulted into it with the additional benefit of employer matching, and you are default selected into a target date fund, which is a passive construction, right? That actually drives inflation, which has a really perverse impact on what alpha actually means. Because it turns out that really what we're trying to do is apply a linear equation to what has become a convex surface, right? If passive is providing an inflationary component, this is not coming through clearly, but you can see that faint curve, right? Alpha is simply the intercept on a y equals mx plus b equation. The return on my portfolio is equal to its beta times the market plus some idiosyncratic factor we're going to call skill. If I use a linear equation to solve a curved surface, my results change over time. At time 0, I get the historic, very little deviation from it. At time 1, my alphas start to fall. By the time we get to time 2 and we start seeing the real inflation in passive, my alphas are structurally negative. This is the actual data. The model is on the left, the actual data is on the right. In other words, we're firing active managers because we're hiring passive managers because the government told us so. Right? In the process, we're destroying price discovery. We're destroying our ability to allocate capital. That's what markets are. Markets are meant to price the marginal cost of capital to facilitate the allocation of capital, not to meet the retirement objectives of the US public. The retirement investment options themselves are increasingly on autopilot. At this point, roughly 80% of all 401ks have a single asset in it, a target date fund. It doesn't leave a lot of room for active managers to compete for those assets or to obtain the assets that would be required to arbitrage away the deviations that are occurring versus fundamental management. Also means your employment prospects suck, but sorry, that was unfair. Okay, so like this all sounds wonderful. Stocks constantly go up, right? Remember that last point I introduced, the portfolio rebalance channel. This is where it gets really kind of crazy. Because if you think about a portfolio that is built like a target date fund, where I have a systematic balance of, let's say, 60-40 or 50, let's make my life simple, 50-50 bonds and equities. Federal Reserve hikes interest rates. What happens to my bond portfolio? It falls in price. I'm now overweight equities, underweight bonds. What do I have to do? Sell equities, buy bonds. Did I do a discounted cash flow analysis? Did I do any fundamental research? Did I calculate the weighted average cost of capital to the third decimal point using a levered beta versus an unlevered beta? You guys all know this stuff, right? No, I did none of that. It's just an algorithm, right? And so what actually happened was when the Fed started hiking interest rates, that passive flow stopped, right? Equity funds basically went sideways during the period of interest rate increases because they were constantly selling their equity position to buy more bonds as bond prices fell. Right, and this has unfortunately now been documented as well. In April of 2023, Zhu Lu, who's now a professor, she was a PhD candidate at Stanford at the time, she's now a professor at Washington, wrote a paper called Monetary Transmission and Portfolio Rebalancing, a cross-sectional approach. We propose that institutional investors' portfolio rebalancing across asset classes contributes to the stock market's puzzlingly large response to monetary shocks. That, unfortunately, is exactly what we saw in 2022. Bond prices rose, bonds were sold, equity prices got sold to rebalance portfolios, bond prices or bond yields were raised, bond prices fell, we had to sell more equities, et cetera, until the Fed was done. And when the Fed was done, again, you guys aren't mostly active market participants, a few of you are, the narrative was, oh, thank God. Now we've got real interest rates. Now we can discount. Now there is an alternative to equities. And by the way, Cliff Asness was super excited because value was finally going to outperform. Right? We've gotten to the point where the most richly valued companies, the speculative nonsense, those values represent cash flows off into the future with real interest rates. We're going to see that fall in value relative to value companies, which have their discounted cash flow valuation largely closed. Anyone know how that call turned out? Not very well. All right, value has dramatically underperformed. Small cap value even worse. Okay, so what can we do about this? First of all, there is no passive investing. We've been sold a lie, and I emphasize sold. I often give this presentation like the CFA, et cetera, but I emphasize that from a fiduciary standpoint, there's a duty to understand, be informed, realize that all of our backtests of historical data now are horribly skewed by the influence of the growth of passive. It'll eventually be unwound. Unfortunately, it looks very much like the XIV when I run simulations on it. The difference is that was a $2.5 billion fund. This is now a $72 trillion asset that represents the entirety of your parents' savings. Education, that's why I'm here. The CFA, clients, policymakers. I will tell you, when I started giving this presentation, I did not give it publicly. I gave it to regulators. And the single most frightening response that I got back was from the Bank of International Settlements. Fed wrote a nice paper. It was basically a he said, she said, because who's the next group that you're going to call when Mike Green comes into your office to tell you that passive is the worst thing ever? Your next call will be to Vanguard, right? And they're like, oh, that guy's crazy, which they could be right about. But and so they wrote a he said, she said. The Bank of International Settlements was even more discombobulating. They said, oh, but we actually agree with your numbers. And they've written a paper on this since. And I said, oh my God, that's fantastic. All right, what can we do about it? They said, there's nothing we can do about it. I'm like, what do you mean? I said, well, what you don't understand is the Vanguard and BlackRock control the regulatory apparatus at this point. And so we could raise the alarm, but unless this happens tomorrow, we're just going to lose our jobs. So we're not doing anything. And that, unfortunately, is where we are. Right? More and more people are aware of this. We all know something's wrong. Right? It's just a question of, can we articulate what it is, and are we going to make any changes? And unfortunately, like where I'm really sad at this point is I don't think we will. It just feels too good. We're driving a car uphill with no brakes. right? Does it matter? No, we can just take our foot off the accelerator, right? What happens when you crest the hill? And that is coming. Because at the end of the day, contributions are always going to be a function of income levels. And withdrawals are always going to be a function of asset levels, right? This is why Warren Buffett's indicator of market capitalization to GDP has historically worked. It's just another way of framing that equation. Asset values relative to incomes. Right now, what we've done is we've added a loading factor to it. We've introduced a new style of investing that causes those valuations to inflate. But ultimately, that raises the assets to the point that those who hold them are going to start to sell them to fund their increasingly extravagant lifestyles, while the rest of us can't do that. Right? And at that point, the system breaks, and it turns into an XIV. And so I like to end with a quote from Voltaire: "Those who can make you believe absurdities can make you commit atrocities." We, I believe, are in the process of destroying the financial markets in order to facilitate the retirement at low cost of the American public. That's where I'll stop.
Always so cheery. Mike Taylor, come on up.
Yeah, I will. Everybody got a mic up? Your mic?
Yeah, we're at Fordham. You have to mic yourself.
We have, Mike, we're going to talk about the example where the crest did happen.
Which one? No.
And
Oh, yeah.
I'm going to start with this story. All right, so 6 months before 9/11,
Yeah.
and you're a politician, and you decided that you're worried about the safety of cockpits. So you go to Congress, and you convince them that we're going to require every cockpit for commercial airlines in the US has to put a lock on the cockpit so nobody can rush in. And the airline says, you gotta be fucking kidding. That's $3,500 a door. I mean, the number of doors. I mean, you're gonna bankrupt the thing. So they fight, and they decide that we're not gonna put locks on cockpits. You lose your job as a regulator, and we don't put locks on. So we have to crash the plane before we're gonna change.
Yeah, I mean, that unfortunately is the same story that the BIS shared, right? Which is, we can clean up after a crisis. We can't necessarily prevent it because the participants have vested interests.
All right, so we very much appreciate everyone coming tonight. So a year ago, almost to the day, Jonah and a few other students had decided to invite Mike Green. They'd seen Mike speak at the James Grant annual event. And they came back and said, Professor, you've got to listen to this guy. I mean, this guy is either crazy or we're completely fucked. And I said, all right, that's pretty binary. I like that.
Both can be
both,
true.
yeah, gotta go with both.
Yeah. And so we're going to invite him to the Christmas party, and he'll be our keynote speaker at the Christmas party. This is great. So I get on the phone with Mike Green because I want to interview him a bit, because we're going to do this same sort of event where he's going to talk and I'm going to do a fireside chat. And I didn't know much about his work, like nothing. So he said to me, first question, what do you know about the passive impact on the market? And I said, well, you know, it's interesting. I get this question all the time. And my answer is so bad, I'm embarrassed to share it with you because I don't know a good answer. He said, oh, no, come on, it can't be that bad. So I start to speak. He goes, no, you're right. So I said, well, explain it to me. And 30 seconds, fair? 30 seconds into it, I said, holy shit. And so I've been a bit of a fanboy ever since. He came to the event. It was spectacular. And I instantly changed the way I answer the question about passives. And Mike and I have become very good friends. At that Christmas event, out of the blue, this gentleman comes up to the stage. I said, who are you? So he says, I'm Mike Taylor. They're business partners. And so we've created that whenever I'm doing events, we like to invite Mike Taylor with us. He's very good friends of Fordham, and he comes and speaks in some of the classes. So I'm a convert, so I'm not going to be great. But I do want to start with one question, because I get this question all the time. As long as flow's coming into, we'll call it the passive mechanism. I don't want to get wordsmithy here. We're fine. We're absolutely fine.
Oh, we're better than fine.
Yes, we're better than fine. You want to be long and maybe even levered. Why not? The
And large
fear that people keep saying, well, Paul, what if outflows go the other way? Don't we have this problem? And it's the story you told me earlier, which shocking, that Vanguard only saw a 1% effective redemption in COVID. The market was down a third, by the way, on 1%. That it's like, that's really scary scenario. But, you know, if we follow unemployment, we follow economics, and we're going to be okay. There's this thing called private equity. And private equity has run out of liquidity. They won't say that, but they have, because they overpaid for the last tranche of deals, and valuations are too high, and they can't sell to each other. So, because the returns of private equity have been so great, I don't know, show me some real numbers. We're going to open this up to individuals.
Yes.
And we're going to make this available to individuals because we've been denying them this asset class. We do it. All right. So my fear is that we open this to individuals and they take money out of their passive mechanism and to put it into there. Don't we have outflows then?
Well, I mean, this is actually the greatest news that ever happened, because the direction that they're trying to go is actually to move the 60-40 portfolio to the 80-20-20, where private equity and private credit and venture are treated as alternative assets. And so it's a net equity increase, right?
So
now,
you actually, you're going to take it out of the bond side, not the...
that is where it is increasingly headed. Now, from an academic or a theoretical framework, this is completely absurd, right? Private equity is just levered equity. It basically runs at a 1.6 beta to the S&P, or slightly higher than the Russell, actually quite a bit higher than the Russell, which has a slightly lower than 1 beta to the S&P right now. And they are levered companies, which, if we draw a direct analog to their public equivalents, we can weight it on an industry basis, we can weight it on an exposure basis, et cetera. Like, the public equivalents are down 6% over the last 5 years, while private equity claims to be up 115%. Meanwhile, the distributions from private equity, as I pointed out, are down about 65%. So there's one of two possible solutions to that. Either they are so good at their jobs that they're able to deliver 1,700 basis points of alpha, slightly more than that actually, and yet still aren't able to make distributions because they're just so good at their job, we should keep investing it with them, right? We want to let that compound, that beautiful, beautiful excess return, or they're just lying. And I kind of lean in the direction of this second.
No. Okay. All right, so I want to go back. We go
They
back.
know they're lying.
What's
They
that?
know they're lying.
They know that. That's
Because
the worst
they know
part.
that there's no way to have redemption.
It doesn't matter if they know.
Yeah.
It matters if Washington knows.
Right, they're willfully
Washington
lying.
knows.
Private equity is willfully lying, which is the worst kind of lying. If you lie because you don't know, then
Yeah.
that's fine.
Just for the audience to know that, like, these things. How many of you have student loan? Anyone have student loan out there? All right.
Oh,
Just a few.
I had a great discussion with my wife about how it was a really good thing because it really opened up the door, and a side effect consequence that we never could have seen coming was that, well, if you get student loans, the tuition costs will go through the roof because now you can borrow more money to pay more money, and they could charge more money. Total accident. Couldn't have seen that coming. And I was like, Jill, are you kidding me? Nothing ever happens by accident in the world of finance. They all know the answer. So I'm sorry, that
No,
was the
I like
segue.
that. All right, so if we go back to 95, we'll call them active managers, managers that believe they're estimating value, comparing that to price at some level, and then allocating capital accordingly. All right. We then know that the flows coming into the market are driven to a large degree in changes in information, changes in fundamental value, things like that. So flows and information are closely correlated. Right, now we have this new buyer that has zero informational relevance whatsoever. And when it was 2% or 10%, fine, but now we get to 50%. So we have half the flows or more that are, we'd argue, is informational neutral, to be fair.
yeah, I mean, I just want to be very, very clear. I think the flows into passive, because active is now negative, right? So it's about 120%.
Right, so actives are now 55%. Just pick a number, they're up from that. But because active has been losing capital, the incremental share of flows is over 100% by definition. And you estimate is at 120-ish?
Yeah, if I look at the total flows that are coming into passive, they're about 120%
And
of the
that
market
flow
flows.
doesn't care about valuation. Doesn't care about information.
It
doesn't care
actually
about
has a
increment.
negative loading for it because
Right,
it buys stocks that have gone up. It spends more incremental capital on stocks that have gone up as compared to stocks that have gone down.
All right, so we now have active managers that are being forced to mirror the indexes because if they underperform by too much, they lose their capital. So we've got this double effect. So this thing is worse than you say.
Oh, I think it's absolutely worse than I said. And then, again, this is some of my most recent stuff is looking at the inside the index components to it. Does anyone know what the largest stock in the Russell 2000, the small cap value index is right now?
I do, but I won't say.
Oh, who said that?
What is it?
Nicely done. What does Oakland do?
They haven't built an SMR yet. Well,
They haven't built an SMR yet, but they will. Does that sound like a value stock?
No.
This is unfortunately what happens, right? Is the idiosyncratic volatility associated with that name combined with the market capitalization means that the incremental flows that come in when people try to buy small cap assets, and in particular small cap value, biases more and more and more of those flows towards ACLA. Anyone know what the largest stock in the Russell 2000 value was in 2021? Come on. No roaring kitty fans in the audience? GameStop.
Oh, yeah, of course.
All right, until
was
the
a value stock,
rebalance.
too.
That was a value stock. Phenomenal value. Only the best types of value. I know value better than anyone else.
All right, so Mike Taylor,
Yes.
you are an active manager.
Yes.
If you can call what he does active. Yeah.
I don't know, it's actually very, very, very challenging to, and this is why you see active managers, they always say, oh, they always, or almost always, many of them underperform the benchmark. And this is a monstrous component as to why. Every time that you pick something that is off the beaten path, not mega cap, you better be right immediately. Because if you are not, there's like this theta of that chunk of the larger caps that will kill your performance.
Relative performance.
Yeah,
Well,
your
this,
relative
again, this is some of the most recent stuff that I was doing. I shared it with some of the people we were speaking with earlier, but there is a competitive response that degrades this, but the pure passive factor at this stage is adding about 40 percentage points a year to Apple. All right, now Apple's not up 40% a year. Apple's actually down. Right? Why? Because nobody with a shred of fundamental information is going to buy Apple. Right? It's a company that has abused its customers. Nobody feels as strongly about their iPhone as they used to. We're all desperately waiting to replace it. We can just get rid of those little green messages or blue, whatever it is for Android. I don't pay attention. But the simple reality is they haven't introduced a decent product in who knows how long. Right? The old products are increasingly derivative. They've lost the Chinese market. Why is this thing trading at 35 times earnings? It's insane. Right? And they've degraded the quality of their balance sheet. Oh yeah, because Apple has huge presence in AI, which they've just outsourced to Google.
Which is pretty good. All right, so Mike Taylor, you take flows into account when you think about investing. So you're looking at fundamental
Absolutely.
value?
In fact, we started this around
Yeah, go back to
2011.
the story. That's what I was leading up to.
So yeah, it started about around 2011, and it was just an observation on how the larger cap names in my space were trading, and I couldn't understand why. And I did the math, and you do that whole matrix and look at this, and you're like, why is this group keep outperforming independent of the fundamentals? And I was a super fundamental guy. I knew these companies like the back of my hand, like lived them. And I'm looking around, I'm like, who is it that's doing this, at Millennium? Because we are, 120 managers are running this fundamental thing, and if it's happening, it has to be us, because we are the market. And then I started to realize maybe we're not the market. Maybe it's something else. I don't exactly understand what's going on, but I need to change my book to start to account for this and account for it, it starts moving like this. Like, for instance, when you would have a large cap that would have a positive surprise, the movement started to become much more exaggerated than a small cap. And it didn't make any sense to me, because everything you learned, that shouldn't happen. And I had been expressing that. Of course, nobody understood what I meant. Nobody understood what I was saying because nobody saw it. And then I met Mike Green at a dinner. And then we were best friends ever since.
Yeah.
Because
actually
he
a
had the
disco,
same
but-
problem from a different approach. He was looking at the math. I was looking at the reality in a book.
And just to put that in context, he's a pain in the ass to be a good friend with, so.
Yeah.
Yeah.
I'm half deaf.
The fact that we're still friends.
All right, flip it to the other side. Seems to me that I want to ride this trade until the day before the VIX
Yeah, no, that's exactly correct.
implodes. What, on that day, what do I, the day before, what should I be, what long dated, out of the money option should I be long that's going to go up by a lot? What's the CD, what's the?
What's the equivalent of the leap puts on
Yeah.
on the XIV? Look, we're not yet inside a window in which this can be traded with any sort of precision. Like my math suggests there's roughly a 30% probability of the event over the next 2 years. In another year, they'll rise. And so it's not yet at the point that I want to express it in that way. I'm still trapped in you've got to play the game. All right, and so all of my work at this point is actually focused on trying to figure out which stocks are most positively and extremely focused on this, and effectively repricing option curves on the individual stocks, as well as building portfolios around this. But just to give you some idea, some of this stuff is very, very recent, but I actually just upgraded some of the tools that I use in some of my portfolios, and it looks like we're creating anywhere from 400 basis points to an additional 1,600 basis points of alpha by focusing on these individual securities. So I don't think active managers are out yet, but it's getting pretty close.
How are you using this
I'll
information?
tell you, and that's a great question. So what's really important, and by the way, you guys, once Mike's books comes out, you're not going to be able to get in a room with him.
You're going to be
That's
really
it.
old.
This
yeah.
is the most important lecture and data series that I've ever seen in my career by a country mile. And I'm not just up talking my friend here. This is incredible. And hopefully this was videoed somehow, some way.
Yes.
Good. And if you didn't understand it, watch it again. If you did understand it, watch it again. This is so powerful. So it's not when the market's going to blow up. You now have information, meaning that you know this. You know how markets are going to trade. You know what the consequences are if it doesn't go the way that they want, meaning this train cannot stop or there will be a tragic calamity that'll happen. And guess who also knows that? Scott Bessent, our Treasury Secretary. You know why he knows it? Because Mike worked for him. That's why. And so he knows it. And so you can now start to predict what the Treasury is going to do and what the Fed is going to do, because they know this. They're not stupid. They can't talk about it. After the book comes out, they have to talk about it, and I'm really curious how that's going to play out, because they will not want to talk about this. We do have a wonderful example, though, of the flows going the wrong way in Japan. We saw this happen already, where the age of the population got to such a point that the flows in turned negative because the population was they're redeeming rather than adding. And a funny thing happened, and we were able to predict this too. Their central bank would not just be printing money and buying bonds, they would start buying stocks to hold up the market. And that's exactly what they did. And guess what they can't do? Stop. They can't stop printing money and buying stocks, or it all goes the wrong way. Yeah. So that's what they're doing. They have inflation. They have an inflation problem right now. I don't understand how it ends. And neither do they. And they still can't stop printing money. I believe that's where it ultimately goes for the US. And you'll see it in Europe first. And you're going to see it in Europe soon, because the demographics are such that this exact same thing is going to happen very shortly. And they will start printing money, and they cannot stop, even if they have inflation, in order to keep the asset prices up.
Yeah, I think that's true about Europe in its totality. I think there's something far more frightening that's actually happening. Is anyone from a small town? Like an actual small town, like a Nebraska farm town sort of thing? Right, like what's
Yes.
happened in these regions, right? Capital has flowed out. The local grocery store is replaced by a Walmart. That means the profits no longer go to support the local schools, the local baseball team, et cetera. They increasingly flow to Bentonville, Arkansas to pay for the climate change objectives of the Walton family.
Was that a slight?
Yeah, that was
Okay.
snark. It's true, but it's snark. And that hollowing out is actually happening to our country, and it's happening internationally. In our country, because the government has now defined that your retirement investments will flow into large multinationals that have nothing better to do with the funds than buy back their own shares to enrich their executives. And by the way, I am completely opposed to the idea that buybacks are the same as dividends, and I can just give you a really, really simple example of that. Imagine Apple pays a dividend. How much of that gets reinvested by Vanguard into Apple stock? 7%, right? Roughly its weight within the S&P 500. Apple does a buyback. How much of that gets reinvested in Apple stock?
120%.
100+%, yeah. Right? The net impact is very, very different if markets are not
How much
perfectly
stock
elastic.
has Apple retired in the last 6 years as a percentage?
I don't know. If I knew the answer, I'd probably be retired.
36%.
Yeah, I think it's 6% a year.
Yeah. And that's had no impact on valuation.
Yeah, of course.
Yeah.
What's amazing, though, is that the Waltons, Walmart, they like it just the way it is. In part because there can't be any competition that comes up to challenge them because there's no IPO market. So, and you say, well, that's a consequence we never could have seen. No, they saw it. Of course they saw it. They always see it. Nothing ever happens by accident.
I'm not entirely sure I agree with Mike. I'm not yet at the level of cynicism that I think that everybody is in on the nefarious information. There are players who are definitely in on the nefarious information.
But I think it's quite possible that Mike Taylor's right in that people are maximizing their own slice, and collectively you're getting
agree with
this
that.
to all scale up. Because I agree with you that everybody is motivated by what they believe is in their own personal best interest.
Yes. It's
Which,
just that
by the
we
way, is
see,
not
we
a
can
bad
see
thing.
through it.
Right,
in all
right,
these
right.
policies. We
We'll
can
see
see
that.
through it with the end consequences if you play it out. It's just that nobody plays it out. And unfortunately, our media, their biggest advertiser is Apple, Walmart, Microsoft, others. And so they're really not allowed to inform us on that.
So the reason we're having speaker series here at Fordham, there are a lot of people at Fordham that support this. Jonah and his team, Georgie and Vic, the center, Rick and I work in the center. We got a lot of things because we're trying to bring this. And I agree with Mike Taylor. I think this is end up being one of the most important lectures you see in your career life. And Miles Thompson, who's my partner, we're helping Mike publish his book. And so when
They are not helping me write it, which is really the problem. But
Yeah. And so when Mike Taylor said, when the book comes out, Miles got very excited because it's like, we would like that to
we actually
happen.
are making real progress
No,
at this
we are.
point.
It's-
Honestly, Mike, the title, I'm still thinking
Yeah.
it should be the best-selling financial book. That's it.
Well, Miles likes the title and he's the publisher, so. All right. I talk to these guys all the time. I'm a huge fan of both of these guys, particularly together. But let's open it up to questions. Jonah, do we have mic? We don't have mics. We have a mic? So we have mics.
We got 2 mics and a mic. There we go.
Yeah, we have 2 mics and a mic. So if you want to practice your outside voice, all right, he's going, I don't know how we're going to get the mic to him.
I will submit this. I run this healthcare fund. It's called, the ticker is PINK, and it's outperformed. I did the same thing 25 years ago for Oppenheimer Funds, and I ran a healthcare swatch, and it outperformed. But my outperformance then, 25 years ago, I regularly put up like 700 basis points of outperformance, which is a lot at that day. But the work that I have to put in now to put in less of a return is so much harder.
Yeah, I believe it.
Cannot believe it.
Well, so just very quickly, Mike is being incredibly humble. His fund has outperformed by about 400 basis points a year since inception. It's incredible.
So half what I used to do.
Oh, stop.
And it's hard.
The rest of us hate him. He's a genuine talent. The rest of us pretend. And I will tell a very quick Mike Taylor story. So Mike, you would not believe this, but actually has been incredibly sick. The reason he left Millennium and Citadel to retire to his bed is because he had an autoimmune disorder in which his spine, the white blood cells in his spine actually attack his nerve endings from inside his spinal column. About 85% of the people that get this disease commit suicide because it is so painful and the swelling that occurs ruptures your vertebrae from the inside. Right, to give you some idea of the pain. Not only did Mike survive it, he figured out a cure. And
I didn't know that. Wow, cool.
so now he's back,
Out of
which is a
necessity.
real pain in the ass because I'd kind of written him off. But
Yeah, no, I'm back, baby.
I know.
We're hitting the road soon with this book.
No more sharing rooms.
Okay, it's off then.
All right, Justin, grab the mic. You're up first.
Okay, thank you. Couple of questions for you. The most basic one I think you just touched on right here. If everything is moving toward passive, then is there any research or any study or any argument to be made for how we pick amongst passive that you would share with the audience? And then I want to ask a question about AI.
Yeah. So again, the quick answer is yes. The long answer is I'm fairly confident I've isolated the passive factor. I'm also fairly confident I'm not giving it away. So,
But you're going to start a fund around it, aren't you?
yeah, so actually earlier today I met with some
An
individual,
anchor investor.
an anchor investor. And so I'm actually going to go, in addition to my ETF and my writing and my various ridiculous stuff that I do with my life, I'm going to actually relaunch a hedge fund to try to take advantage of this. So we'll see what happens.
Okay, and the second question is, let's look into the future a little bit on AI. A couple of things could happen. I'm sure you saw Ken Griffin saying AI is not helping us generate, I believe it was individual stock returns, but maybe I'm wrong on that. In a couple of years, I can imagine it playing out a couple of different ways. One, AI becomes so sophisticated that they become a great investor where they're picking individual stocks very, very well. And suddenly, maybe things could go back to active. Another way is they just discover the best way to do this, like in war games, is best way to do. The best way to win the game is to not play at all, and they just become index investors. Do you have any thoughts on this and how this could change the world? Because I really can't decide which way it'll go.
Yeah, so let's split the two, right? It doesn't matter whether it's AI or whether it's active managers, whatever. If somebody figures out a better mousetrap, could we ultimately be passive at the game?
Mike Taylor.
And this is part of my point, right? People who are aware of the rules of the game are actually starting to figure out how to exploit it. The Millenniums and Citadels of the world have moved to index arbitrage. That's by far their largest individual business in the equity long-short space. It's become a tremendous source of profitability. Many firms have actually migrated away from traditional prop trading towards things like high-frequency or market-making activities. Firms like Virtu, et cetera, that used to trade very actively on a high-frequency trading framework have largely moved to market-making, Jane Street, et cetera. These are all extraordinary firms.
I had to go there.
What's that?
I had to go there to James.
Yeah, well, I'm sorry. No, I mean, these are all extraordinary firms. What they've recognized is that 36% of market activity that I highlighted is the facilitation of ETF trading. Almost all of my derivative funds in the ETF space have Jane Street as their market maker. One, they're smarter than I am, and so they can figure out how to arbitrage me. And two, they are by far the best at pricing complex securities in terms of market-making activity. Can a new manager figure out how to, like, can a new technology emerge that allows us to take advantage of it? Yes, but it can happen in the context of I can go raise $1 billion and I can trade this, right? I could probably get to $50 billion and trade this. That would be give or take 6 months of Vanguard's inflows, right? It's just not that much money, right? There's not much capital that can be put up against this. Vanguard last year, I'm actually underselling Vanguard. Last year, Vanguard took in $400 billion. Right? It's just so off scale versus anything else. It's not even
I
close.
assume you still have a question.
Yeah.
Stand up, speak loudly, and we'll repeat it if we have to.
Well, I hope loud isn't a problem. When it comes, wasn't this entirely predictable with the demographic shifts that we've been seeing, considering the size of Gen Z and Gen X in comparison to the size of the boomers, and the aging boomer population will predictably move their funds into safer assets
Well, they haven't done
Wait,
that.
perceived safer assets?
Yeah, but they haven't done that. Wait,
In 2022, didn't they start to move a large portion of their money towards bonds?
only because of the rebalancing component.
But wait, freeze. So what
flows-
Mike's saying is it's not individuals, it's the funds themselves rebalancing. Your comment is that as the boomers, we retire,
It's not really happening in large numbers yet, but we're starting to see that movement and, in terms of retirement. So as the population shifts demographically, wouldn't we start to see this, basically come true, what you're predicting coming true as an explanatory variable?
because they're going to take out of equities, they're going to rebalance to.
Well,
So
that's only if they
your
don't
point
have
is that because,
401ks.
wait, I just want to be clear. So what you're saying is, what is predictable? The inflation tied to passive
I'm gonna reframe this
investing,
for you.
or the crash tied to a demographic rebalancing?
Here's the setup.
Yeah. No,
All right,
I understand the
got it.
setup.
Perfect.
Okay. So the quick answer is the way we chose to invest meaningfully affects it. If we were to go back to 1970, I would say the answer is no, because what we would have largely done is put people into defined benefit annuity plans, which would have targeted a particular return profile and returned income to people in retirement. With the change in ERISA and the introduction of 401ks in 1977, 1978, and then the shift to qualified default investment alternative under the Pension Protection Act, we changed the way that we save for retirement to, instead of accumulating a claim on income, we now have assets that we presume remain liquid that allow us to sell them, right? So the liquidity and the ability to tap into retirement assets for the boomers is increasingly predicated on their ability to sell. That doesn't necessarily have to be true. It's not necessarily true in the demographic framework. It's true because of the way we chose to save for retirement.
Yeah, I don't think that Gen Z, as long as everyone is collecting a W-2, nothing will change.
Yeah, I think there's a
But
lot of truth
Mike
to that.
Taylor, I love your answer, but I'm going to just modify it slightly. As long as the aggregate is collecting a W-2,
It's actually not even that.
nothing's going to change.
Yeah,
Right.
it's not even that, actually. So this is also one of the other demographic features. Remember that old people own assets, and so they've accumulated them throughout their lifetimes. They actually are the disproportionate owners of the actively managed funds. The real reason actively managed funds started outflows in 2015 is because, give or take, that's when boomers started to turn 65 and 70, right? At which point they started to take withdrawals from the vehicles that they had invested in, which were largely active managers. When I talk about passive being 53% of the market, I often emphasize this, I probably should have in this group, that's not a homogeneous distribution. It's not like Mike has 53% passive and Paul has 53% passive and I have 53% passive. The reality is that those over the age of 65 who have about 70% of the assets are only about 25% passive. Those under the age of 40, because of the changes in methodology and how we save for retirement in 2006, have about 90+% passive.
So that reinforces your concern as demographics.
Well, actually, no, I want to be very clear. It actually defrays the concern, because what is happening is boomers are retiring. They're starting to take distributions from their active managers, because the Federal Reserve has hiked interest rates so that there's $7 trillion in money market funds, which are disproportionately held by the older generation, are now generating significantly greater income than they had anticipated. They have to sell fewer equities in aggregate. When they do take the distribution from their 401k, they sell the active manager, who has a multiplier of 2, and reinvest the surplus proceeds into a passive vehicle that has a multiplier of 20.
So you actually end up, boomers do this, they actually add to the
They add
problem,
juice
not
to
the
the
other way
fire,
around.
yeah.
So if the administration
Wood to
can
the
get
fire.
rates to go from 4.5 to 2, that sounds like a bad idea.
Well, it can be bad and it can be good, right? Because what it'll ultimately do is drive bond prices up. The initial reaction to that will be to sell bonds, buy equities, to rebalance the portfolios in the reverse. And then we discover that the income is decreased and people need to sell more. So like that's one of the concerns I have, is that ultimately events will occur that cause the Fed to cut interest rates.
Jonah, you're up.
So thank you both for coming tonight. This, amazing opportunity to hear you guys speak. Question for Mike Taylor. You know, I could tell that as a portfolio manager, you clearly value idiosyncrasy as like a very important factor in your portfolio. How does Mr. Green's work impact the way you look at idiosyncrasy? Does the rise in correlations between stocks, is that eroding the value of that or making it harder to find?
I'll give you an example. Meta and Oracle have a material problem moving forward with debt. And for that reason, I bought many, many, many millions of dollars of Apple. I went up 10% in the past 3 weeks. So if you can create a fear around debt, because that's the one thing that kills this whole thing is a credit calamity. And
So wait, so the Apple goes up because it's perceived as the safe, because it's negative debt?
because the passive, because they have to reallocate a little bit, and that tiny little bit of reallocation at the large cap from Oracle and Meta, it just trickles into Apple.
Yep.
But then you get the passive behind it on the back, and so you get a massively exaggerated move, just like we did in the past 3 weeks.
Yeah, there's a fantastic paper that is wrong that actually hits on exactly the phenomenon that Mike is
And I can
saying.
capitalize on that, knowing, or at least hope it's more than
Modeling,
hope.
modeling,
Let's say a educated hope that this is actually what's going to happen to this stock, even though I hate that stock.
From a fundamental
From
perspective.
a fundamental
Yeah.
perspective.
Right.
And so what you have to do is decide that you do not want to be right. You want to make money instead.
Mm-hmm.
And that is the secret to having a tremendous return, is that you have to sort of free your mind from being right and understand that there are flows in action right here that will cause stocks to exaggerate the moves a lot of Mike Green. And I cite Mike Green probably in every speech that I do, and they're like, who? Well,
Yeah, we'll
That's the
change
right
that. We'll
rea-
change that.
That's
We're
the
gonna-
right reaction, by the way. I just actually want to hit on something that Mike just said. So this is actually a perfect illustration of this. If you look at what happened to Oracle in the past couple of weeks, they announced a partnership with OpenAI. The stock price exploded to the top side. That actually is somewhat counterproductive because a move of that magnitude actually draws in the competitive response, right? Enough active managers are drawn to that fast money components in terms of hedge funds, et cetera, that they actually start trading against it. It's enough of a move to actually cause a reaction, and that then causes that to degrade. Cam Harvey actually just released a paper 3 months ago that identifies this, and there's roughly a 2-week to 3-week reversion process to it. So you move 30% or 25% in a single day, you're gonna draw in competitive response. But what happens if you just release a series of little incremental moves that cause you to rise 1% or 2% or 3%, right? It's not enough to create the arbitrage capability that the active managers are drawn in to take the risk to trade against you. And then the passive flows come in and validate it. And so the best strategy is to do something like what Palantir does, not announce a giant partnership, let's just constantly be announcing stuff.
Yep. So what's amazing now, and I was trying to figure out when this would happen, when we would start seeing incredible exaggerated moves in large cap names because there aren't enough active people anymore to take the other side. So it's getting a little crazy now because I believe it's largely because of passive, and that we're seeing it now. And I didn't know when we'd see it, but I think we're seeing it now on quarters, on events, on just periods of time where the large cap movements are absolutely staggering movements. And you can see it in the options now where the realized vol, I'm sorry, what does that mean? Okay,
They're
an
finance.
unbelievably highly
know it.
priced option that you're like, God, that could never happen, actually happens every time, over and over and over again. And now we're seeing large cap names having such unbelievable moves on the quarters. It has a lot to, or events, it has a lot to do with just this, where the active people are getting squeezed out. And so there's nobody that can come in with a hammer of rationality because the passive doesn't care, doesn't even know.
Does anyone here have a Robinhood account that they've traded options in? There's no embarrassment if you, all right, you up there, okay. What do they tell you is the implied volatility on an option?
I'd have to check.
No, you don't. They don't. They don't tell you. They don't disclose that information.
Oh, I bet they don't, right?
No, they don't. They
Yeah.
just, so people
Yeah.
will literally
That's right.
sort the options to look for the cheapest option in terms of dollar price. You can actually see this in the algorithms that are happening at Robinhood with no awareness whatsoever about what the actual implied volatility is. Right? It is a money printing instrument for Citadel.
It's staggering, and I've had to change what I do and how big I am in certain large cap names, especially around events, because the movements are so staggering. And this is, and the problem is, I promise you next year it's worse. And I can't tell you a year that it's not worse or more exaggerated, because it's getting, I'm sincerely worried. Sincerely, I'll probably make a lot of money, but I'm really, when you see these kind of things, like these movements in names only happen when we're under duress, meaning the volatility.
Mike,
And we're not.
you know, the Oracle move was something that I've never seen in my career.
Yeah.
Magnitude, the dollar creation.
Honestly,
in that
put the
move.
ticker there, just fill in a new ticker, because.
I agree,
it's
but
just-
we've never seen these kind of moves before.
Just,
No, it's not.
just on
And
and
they're-
on and on and on and on.
Well, what's
And
100 billion between friends?
that's the point, is that there's no rational investor in between to say, no, that's too much. Or there are, and they can't do anything about it because they don't have a big enough hammer to actually move the stock anymore. When we were at Millennium 15 years ago, we ran the market. We said what the price would be in my space. And because we all did our nerdy things and did the Excel spreadsheet, we go and bang, within $1, that's where it would be. That's not what happens now. It's something else. And you can't model it. Well, Mike Green did.
He's modeling.
But Mike Taylor can't.
Go ahead.
So,
Hi. Thank you very much for the presentation. It was really interesting. So I was just wondering that you were saying there is less and less price discovery happening, and that there is some sort of a positive loop back, wherein
Some sort of what, I'm sorry?
Positive loop.
positive loop
Oh,
back,
oh yeah, positive feedback loop,
positive
okay.
feedback, yeah.
Yep.
And what I was wondering was that when I do DCFs to calculate, cost of
Oh,
capital.
so you're the one, okay.
Told you there was one.
Yeah, there had to
look
be.
at that.
So now I use capital asset pricing model to calculate the cost of capital. What I would like to understand is, how would I change it based on what you've said? Or should I just completely throw away DCFs?
Can I take a crack at this
Yeah.
for a second?
Well, I mean, so just very quickly, I write a Substack. Anyone is free to read it. There is a paid subscription. I give away subscriptions like mad, particularly to people with academic backgrounds, because I don't care about the money per se. I'm much more interested in the spreading the information. So just ask, and I'll give it to you for free. Right? It's that simple. I've actually walked through some of these examples, and the real problem is that a DCF is going to give you the answer based on your forecast of particular fundamentals. The right way to think about DCF is it incorporates everybody's perspective on those fundamentals, and there's kind of a possibilities cloud that exists around it, right? That can only work if those players have enough capital to force the extreme observations in the other direction. And they just don't right now. They have negative capital, which means they're losing funds. When I wrote a Substack piece very recently on this, it sounds completely crazy. I think Apple is probably worth about 20% of what it's currently trading at, right? That sounds nuts. This poor professor over here reacted, or you're a professor, right? I got that right? Oh, you're a student. Okay, this poor student over here
He's
thought
very well dressed.
he
for a
is
student.
very well
Be
dressed.
suspicious
I
of
do
that.
like programs that get people into suit and tie. I used to wear them too. He was like, wait, you think like $800 billion of market cap? And I'm like, yeah. He's like, wow, I thought I was crazy at 1.3 trillion. And it's pretty funny. Like if Bloomberg has a default dividend discount model in it. If you plug in Apple, it comes back and it says it's worth about $50 a share. It's currently trading near 200. right?
You know, Mike, I'm going to reframe this for a second.
Yeah.
Get to the same answer. If you did a reverse DCF to say that the market's correct, what are the implied implications? And this is what I've shared this with you, obviously.
Yeah.
You come up with, if you just isolate it on growth, you come up with growth that's impossible for them to achieve,
Yeah.
which is another way. However, it doesn't matter unless fundamentals set price.
Unless fundamentals set price. And this is part of, the language that I try to use. I'm nowhere near as colorful as Mike on this stuff, but the language I try to use to explain this is it's like shouting the emperor has no clothes at a nude beach. Like everybody knows already, right? It's like, oh, the market is overvalued. Oh, thank you. That was really information content. I really appreciate that. No, we know the market is overvalued. We know that this is crazy, right? What we're currently engaged in is the silly season narrative to try to explain it on a fundamental basis, right? Because most people don't want to accept the reality that we've handed control of the markets over to algorithms that are ostensibly there to help the American public and save them 50 basis points on their asset management fees. Right. I actually want to be very, very clear. I think passive investing, as we define it as index investing, is still probably the best investment vehicle for most retail individuals. But by not effectively taxing it, we've created a tragedy of the commons. Right? What should happen is that you're eligible to invest in passive on a somewhat advantaged basis on a taxable component up to a certain point. But like when Warren Buffett says, gosh, I'm going to really have my wife, get her $60 billion invested into passive vehicles because I don't want her being taken advantage of Wall Street Sharpies. It's like, dude, she's worth $60 billion. She should be actually thinking about where to allocate that capital or hire people who can, right? To outsource that to the public is absurd.
To get back on your DCF question, because it kind of burned a hole in my head here, versus disregard it. See, if you backed it out and you said, well, what is it really implying, what it's actually worth? It's actually, what it says to me, and Mike does it in Excel, I use a napkin, it means the WACC is about 2.5%.
You could solve for the WACC instead. So do a reverse DCF, solve for the implied return.
You solve for the implied
But it doesn't matter unless fundamentals came along and dictated the incremental price. And the whole lecture is about, Jenny, I'm going to come to you next.
So for
the whole
large
lecture,
cap, the WACC's about 2.5.
Yeah, I actually don't think
Back
that's
of my
right either,
head,
but yeah.
that's the number I come up with.
I can't get there with a 2.5% WACC, but the point that I would emphasize is you should do the DCF for the same reason that you should be aware that if you stand too close to the edge of the Grand Canyon, you can fall in, right? We're standing on the edge of the Grand Canyon, right? You don't want to be the person who's in front.
particularly if the
But
credit gets a
otherwise,
little.
you can't use the DCF because then you're fired.
Right. No, that's exactly correct.
So, and
That's
and
okay,
by
your
the way,
firm's
you're not
losing
alone.
assets, and
Everyone's in
AI is
that
gonna replace
same
you.
thing. You guys, we're Thelma and Louise. We're right here. But we still got runway. We're good.
Jenny,
Let's grab Jenny.
Follow-up question.
We're going to run out of time. I'd love to get Jenny's question. I apologize. I'm happy to
here's the
talk to
mic.
you afterwards.
She's about to hand you the mic.
Thank you. I have two questions. Thank you both for being here. If Scott Bessent and everyone else knows this,
Well.
can you please help me understand why, from a policy perspective, there aren't reversals of key things, right? The use of leverage, the no contest rule for diversification, whatever. Why on the margin are they not making changes to potentially avert
Yes.
before there's no active managers left? A. B, can you walk through the structure, the mechanics of how the market has broadened over the last month or two, right? There's been increased breadth. If the flows are continuing in, as we say, there should be nothing but increased concentration.
Yeah, and I want to emphasize.
Thank you.
Yeah, so let me hit my side of it first, and I'll talk a little bit about that as well. But look, the reality is trying to change it could crash the market,
So I think
and
that's
that would
the
be
fact.
bad, right?
But if there's still some active managers, like,
It's down
We
80%,
don't-
it doesn't matter.
We
I mean,
also.
it really doesn't matter.
You would argue we're past the point of no return on that issue,
I
because it's just size.
I mean, I'll go a step further and just say, like, I've had these discussions, right? And the simple answer is they can't run the risk to disrupt what President Trump thinks is the single most important leading indicator of his popularity.
Imagine that
He has popularity?
Imagine that
Oh,
we're
remarkable.
at
You
war.
live in New York City. You need to get out more.
So imagine that we're at war because we are constantly engaged in financial and even physical battle all the time with all the interests all over the world. It is not peaceful like it actually appears. Japan is a vassal state. The UK is a vassal state. What ultimately is going to happen, in my view, Mike and I talk about this all the time, there's certain things that we can't undo. One is that females are not having babies for many reasons. And so we are going to have a crashing demographic worldwide in the industrialized world, where all the debt is. And you can see it in many countries now. The US is in a little bit better shape because, so we're gonna outrun them. And eventually we'll all be printing money nasty. But I think that that's what the real goal is. Hold it all together, because eventually they're all going to blow up and we'll be last. And we'll have changes happen, we just need to outrun them so that we can last longer, because there will be a seismic change at some point in our lifetime because of this demographic problem, because the fractional banking system doesn't work. You can't have a hurdle rate that's positive when the aggregate demand is negative.
You guys are making this more fun. Georgia, you're up.
Mr. Green, Mr. Taylor, thank you for the time. I just wanted to ask, aside from what happened in Japan, are there other examples you can study where this has become an issue? Perhaps like the period before the Great Depression, when many managers were essentially engaging in a form of indexes.
Yeah, so unfortunately, I think that is actually a very accurate comparison. The use of leverage, closed-end funds, unit trusts, et cetera, in the 1920s very closely resembled some of the components that we talk about now. The single best example, actually, is the one that led me to figure out how this drove the dot-com bubble. 2014, 2015, I was running my own hedge fund. And the Chinese stock market is actually, Scott Bessent, this is where I worked with Scott. Scott Bessent made an offhanded comment to me that, oh, the Chinese have solved it. They're just going to equitize. This is back when everyone was really concerned about surging Chinese debt. And, well, they're just going to equitize it. They'll sell off the equities to the rest of the world. The rest of the world's going to pay inflated prices. That'll allow them to de-lever, and everything will work out great, right? And from December of 2014 until, give or take, June of 2015, the Chinese stock market, various components of it, but the aggregate rose somewhere in the neighborhood of 180%, something like that. What was actually happening there was fascinating. And so at my hedge fund, I was actually running this analysis, was feeding it to Scott, who was running Soros at the time. What actually occurred was the same phenomenon that happened in the US markets in the 1990s. You had Western investors who wanted access to the Chinese stock market, couldn't access it because they didn't have qualified financial institution, international institution status, QFII status, in terms of investing directly in China, so they would buy through the Singapore futures. The Singapore futures merchants would brokers would in turn try to replicate the positions in the Chinese stock market in order to facilitate transactions. In the Chinese stock market, they were the only major stock market left that still had market cap weighting. And the unique feature of the Shanghai Composite was that it had many stocks that were reasonably sizable within the index that had as little as 5% float outstanding. Right, so the Singapore futures brokers would go to try to buy in proportion to the market capitalization. This is where another rule in China then kicked in. They had volatility limits on individual stocks to limit speculation. And so if the stock clearing price was up more than 10%, it would simply go limit up and you'd try to clear it the next day. As of June 2015, when this peaked, about 10.5% of the Chinese stock market was going limit up every single day with 0 transactions. Right? One stock that we were tracking was up 32 consecutive days, 10% a day, without a single transaction happening in those 32 days. right? 1.1 to the 32nd power is a big number no matter how small you start, right? That's what was actually happening in the Chinese stock market. That's how I was able to figure out what actually happened in the US stock market.
Spencer.
Hi there. Thank you guys so much. This has been great. And one comment in particular that stood out to me that, or resonated with me rather, was despite that, passive has usurped so much of the price discovery and functionality and transmission mechanism of markets that, we still see upon earnings, that bad companies are being taken out to the woodshed, and positive earning surprises, you're getting maybe exaggerated, movements in prices, very well, point taken, but you're still seeing some mechanism of price discovery. And, you get passive vehicles that are fairly inexpensive and cheap. And I say all this as an active manager, so, how do you reconcile those two things with, you do still having some forms of price discovery and it being more of a concentration risk at the top?
It's for 48 hours each quarter. Pretty much that's it.
Yeah,
And Mike Taylor, that, to some degree, that's the pod shop, to some degree, right?
Oh, yeah.
Yeah, okay.
Oh, yeah, no, the pod shops, Millennium, Citadel, I mean, that's where they make all of their money, is 48 hours each quarter.
Well, and you've asked a question. Over here.
Well, wait, but before we go on from that, I just want to emphasize something. So first of all, that is price discovery, but it's not value discovery, right? And so actually part of what you're relying on price discovery is it's supposed to converge to value. That's why markets are ultimately marginal pricing mechanisms for cost of capital. They're not designed to be retirement services.
We'll do
right?
one more,
So
and then you.
what you are highlighting is that the market has actually moved to discovery of where the clearing price is. That's a radically different statement than it's reflecting the fundamentals.
The value based on future free cash flows, yeah, we don't do that.
Right? If you're an active manager, by the way, I don't know if you've ever traded derivatives with French banks, but the reason they always blow up is they price not to model or to theoretical frameworks, they price to transactions. Right? That's what markets are doing.
To add on to that, and that future free cash flows, I'd like to tack on the greatest free cash flow investor of all time, always diversified, the most sanguine man on earth, Warren Buffett. Yeah, he cheated too. 50% of his book was Apple.
Yeah, he also doesn't talk about the derivatives that he widely used to hedge.
So,
Or the leverage from his insurance fund.
Actually, well, by the way, the single biggest cheat that Warren Buffett did is for years and years and years, he resisted inclusion of Berkshire Hathaway in the S&P 500. Post-2008, he engineered an acquisition of Norfolk Southern that actually reverse flipped Berkshire Hathaway into the S&P 500, thereby guaranteeing his participation in passive flows. He's made far more money from that decision than on anything else.
Apple didn't hurt. All right, we're going to do two more questions. This gentleman and then you in the blue sweater.
Thank you all for being here. Kind of segueing from that Berkshire Hathaway question, I was just thinking, if regulators know, a lot of the market, all the sharp market knows, do the companies know as well? Because if first off, you're seeing this insane deal side action that makes no sense, that's propped up by these huge valuations. If I was a CFO of a company and I needed to finance something, or I'm going to expand into data centers or something, there's no way I'm missing this. There's no way I think that people are pricing my stock. And I know what my stock is worth. I feel like the Apple team, it's not like they're doing that. It's not like they just are like, wow, we're such a great company, Are they contributing to this kind of positive feedback loop, and are they taking advantage, which is kind of furthermore supercharging not only the Mag 7, but the rest of these large cap and even these large small cap stocks?
So the quick answer is there are varying degrees of awareness. I would suggest that some are extraordinarily aware. I would suggest it is the greatest irony that Elon Musk hijacked his last earnings call to speak to the importance of him receiving his $1 trillion pay package in order to make sure that Vanguard does not end up getting control of his company. Of course, Vanguard voted for the pay package. My analysis is that many in Silicon Valley actually know this, and some are more aware than others, in part because I worked for them. So there are firms like Palantir. In my opinion, Palantir has actually been built to exploit this.
Part of the strategy is to
Yeah.
exploit this.
If you guys didn't know, Palantir is trading at 80 times forward revenue.
It's a value, Mike, it's a value stock.
I've never, ever seen anything remotely like it.
So I think we're basically discounting the importance of bankrolling our retirees. I think that we're sort of, the actual reality of where we're at is that everything is pretty solid for most people, and that just because people know things are taking advantage of them isn't a reason to freak out. And that's sort of flies in the face of what you're saying. And I'm curious. We've had people before talk about what are policies that will change this. How can we circumvent this incoming collapse, right? That's all good. However, before we talk about the Norwegian investment bank, they're acting as a pension fund. There are advanced ways we could circumvent this with different policies. I think not talking about the Fed is. I think that's the big issue here is that the Fed's independence is people freak out over that, and Trump takes somebody off the thing, everyone's going to sell off, and then you'll have one of those 5 days where everything goes down by 10%, right? But isn't that that's an active move? That's an issue that we can you can actually avoid this.
Well, I don't think you can avoid the systematic issue, is that if we ever did have a credit crisis again, which we will, it will be in a limit down fashion we've never seen before because there's nobody on the other side on equities.
Well, I just want to make sure I understand what your point is. Is your assertion that I'm concerned because retirees have become wealthy?
I think that that's the reality of what we have is that boomers are doing really well, and retirees are doing really well.
Okay.
It's tracking to keep
Yeah, but they'll all be dead, and it's your money then anyway.
Yeah.
You got parents, right?
Yeah.
There you go. Win.
Yeah, you're fine.
Yeah. It's yours. It's not them. It's you.
I feel like I just think that if things stay as they are right now forever, isn't that good?
Yeah, of
Yeah,
course,
we-
of course. Absolutely agree. If they stay like this forever,
Yes.
Well,
No,
among
it
other
is good.
things, can we go back
If there
10
is
years? I'd like to
never
be
a
on
financial calamity, you're right.
all right.
U.S.
Yeah, no, I love it. I'm going to ask the last question because I'm the host, and I'm going to poke the bear, and then we're stopping. We have food that is now stale outside of networking and all that. So my final question, we did not touch on. I assume the students would ask, so I didn't ask. We asked AI, and this is going to be the popcorn round. So you get 1 sentence: good for your thesis or bad for your thesis?
Yes.
Yes.
No,
And-
no, I mean, we talk about this a lot, and I think I'm more worried about it than Mike is.
And wait, freeze. And you're worried because the implication on unemployment?
I'm worried about the whole, because it's happening much faster than I thought. I see it in my businesses, my private businesses, all the businesses I know. It's going to be very difficult for the younger population getting jobs a bit, white-collar jobs, and it's happening very quickly as I see it. And so we're going to have like a 3-year hole. It's happening too quick.
So the technology
gonna
pace
have-
is just too fast. It's the
Well,
adoption.
it's too fast, and it's subbing people out it's very difficult to retrain a highly skilled white-collar individual in something.
I'll take that a step further. First of all, the retraining never works. Right? The simple reality is there is no retraining program in history that has ever redeployed resources. Old people get old. They eventually figure out how to live on their children's couches. And they're replaced by newer job entrants, either immigrants or people graduating from school. It's a fallacy that you can retrain auto workers to become interior designers or anything else, right? AI, more than anything else, is actually creating a hesitancy to hire young people because people are unsure of the contract that they're entering into. and the value of that. I personally find LLMs and AI to be extraordinarily useful in my career, right? I think of it as I've got a first-year investment banking analyst
That will do whatever you.
that will literally do whatever I want except for get me coffee and make copies.
That's my job.
Right. I'm so happy he's feeling better. But what I do now have is literally a group of, an unlimited number of first-year investment banking analysts. They're really smart. They're really motivated. They've read a lot of shit. Do they have a fucking clue what they're talking about? No. Do I trust their work? No. But man, are they productive.
Yes.
Right? They can produce endless quantities of stuff, and as long as I have the domain-specific knowledge to turn around and say, well, that was stupid, right? Then I can redirect their resources. But it's an extraordinary tool for me, but it is the very first tool that causes me to say, do I really want to hire somebody in their first year out of a master's in finance program? Right?
Unemployment among people that are under 25 is 11%.
Yeah, and if you do that...
In an economy that has 4.2% unemployment, by the way.
Yeah.
I know, it makes no sense, right?
Right.
No, it makes perfect sense.
Well, unless you're subbing the people out.
Right.
You're not, it's not
And
so much as you're-
Or I'm
it's just a
leaning this
hesitancy.
way. Or you're pausing
Yeah.
because you're not sure.
Right.
And the economy's a little uncertain and all of that. All right. We've been here for, I take questions all night. We've been here for 2 hours. You guys have been incredibly patient. I think everybody said, no, mine's really good. Mine's really good. There are 30 people that have the best question. So we're going to end now. These gentlemen are never going to leave the stage because you're going to rush down here. We have food and soft drinks behind us, and we thank everybody for coming. Thank you very much.
Thank you.
All right,
I wanted
mics.
to add
Mics
for
from the
all of
mics.
our guests.
Don't.
You guys are way smarter than we were at this age. So it is, without a doubt, brilliant. Oh, thank you.